Benjamin Graham's The Intelligent Investor remains one of the most important books written on investing. First published in 1949, it has served as a Bible for investors to navigate their way through the complexities of financial markets with discipline and logic. Graham is often termed the father of value investing, and this book supplies the reader with an all-encompassing guide to stock market investing, a rational approach, long-term strategies, and a focus on the intrinsic value of investments. The core principle of asterisk. The intelligent investor is that successful investment requires more than knowledge about market conditions or forecasts. Instead, it is a disciplined state of mind that can hold out against the emotional highs and lows of market volatility. The book expounds key principles that help investors make sound decisions and avoid big losses and speculative bubbles. This summary summarized the salient points in The Intelligent Investor, breaking the book into manageable parts that encapsulate its main ideas. 1. The basic principles of value investing, a long-term approach. It is with this concept of value investing that builds the center of this book. The intelligent investor, of buying stock, priced less than its intrinsic value. The investor, according to Graham, should look for firms whose stock prices do not reckon the value tagged as intrinsic. Thus, purchasing such stocks at a discount or at a lower price, and waiting for the price to correct themselves, will probably yield long-run profit. He emphasizes that investing in stocks is quite different from speculating. Instead of scrutinizing the fundamentals of the company, which comprise the earnings, assets, the quality of management, and the prospect of a firm about the future, the speculators instead gamble by trading in firm stock without regard to the value of the company. Graham goes on to say that one must be a long-term value investor. Don't attempt market timing or try to run with the big boys, buying sound companies at reasonable prices and holding on to them for the long term. That lowers the chances of getting caught in a market craze, which happens more often than not in weak investment decisions. 2. Mr. Market. Making sense of volatility in the market. One of Graham's most famous metaphors is Mr. Market. He likens Mr. Market to a business partner. This guy comes around every day and offers either to buy your shares or sell you his shares. But Mr. Market happens to have highly erratic emotions. At times, he is very optimistic and wants to buy your shares at too high a price. At other times, he can be pessimistic and he wants to sell you his shares at a discount. The lesson Graham teaches from this metaphor is that investors, of course, should never be emotional like Mr. Market. Rather than trying to guess what Mr. Market will do next or chasing behind him, investors should use his irrationality to their advantage. When Mr. Market is in a pessimistic mood and sells stocks at a very low price, then investors should buy. On the other hand, if Mr. Market is too enthusiastic, blowing up all stock prices, then it is time to sell or at least wait for new opportunities. Treat the market like a volatile but predictable partner. Avoid pitfalls that lead to poor choices and try to be as rational as possible, not letting the noise of the marketplace decide what you invest in. 3. Margin of safety. The core principle of value investing. The second fundamental principle of Graham's thinking style is the margin of safety. This term simply means acquiring stocks that have a value significantly lower than their intrinsic worth. By doing so, investors protect themselves from unanticipable events or misjudgments that may imperil the stock price of such a company. Graham advises that even no matter how much an investor researches the fundamentals of a firm, there is always going to be some degree of uncertainty. The margin of safety is what cushions an investor in case they experience losses without losing their entire investment. For example, if an investor thinks that the intrinsic value of a stock is $100 and has it for $70, then the range of $30 is the margin of safety. This principle applies not only to individual stock purchases, but also to the overall structure of the portfolio. Another way of coming at that margin of safety is through diversification, or spreading investments across a range of assets. By holding a mix of stocks, bonds, and other securities, investors can diminish the impact of any poor performer on their overall wealth. Once you grasp these principles and come to grasp them, it's time to learn whether you should be either a defensive or enterprising investor. 4. According to Graham, there are mainly two kinds of investors: defensive and enterprising. Defensive investors. Defensive investors are those who prefer safety and a constant income on their investments. They dislike making active decisions about their portfolios. Defensive investors should focus on having a diversified portfolio made of high-quality stocks and bonds. Graham recommends that a portfolio for defensive investors should hold no more than 75% of stocks and no less than 25% bonds, and it must allow for both growth and income to be attained. Defensive investors must not invest in speculative stocks. Instead, they should invest only in blue-chip corporations having stable track record of earnings and income receipts for several years. Graham also lays stress on the dollar-cost averaging strategy to be adopted by defensive investors by investing a constant amount of money at regular intervals of time with minimal consideration toward the prevailing market conditions. This would lessen the chance. Enterprising investors. These investors will require more time and energy to develop the research effort and can tolerate greater risks for higher returns. Enterprising investors will be far more active in their management of portfolios and regularly seek undervalued stocks, special situations, and other opportunities that require more detail. The enterprising investor cannot leave any stone unturned in search of investment opportunities, as Graham shows significant detail regarding how to go about searching. He illustrates concretely companies with good finance, a history of growth in earnings, and a stock price below not just book value, but likely earnings. But he also cautions that this active investor is at more risk and requires more dedication to research and discipline. 5. Role of bonds in a portfolio. For her part, Graham puts emphasis on bonds as part of a balanced portfolio in investing. Although bonds are stable sources of income, they dampen the volatility of equities. Quality bonds, which include government and investment-grade corporate bonds, in the opinion of Graham, should constitute a certain percentage of an investor's portfolio. Defensive investors are expected to allocate at least 25% of the portfolio in bonds, and the remaining should be given to stocks. No fixed proportion of bonds is allocated to the enterprising investors. They must consider the market conditions or risk appetite and adjustment, and they must always keep a balanced mix to avoid taking unnecessary risk.